Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Real estate experiment. What is happening, y'all? Today, I have the pleasure of having Mark Khuri step into the lab with us. And Mark, look, I'm very excited to get into this one because, Mark, when we talk of having experience, of coming in with tons of vertical and horizontal experience, you are that guy. And the reason, what's really important about what we talk about the real estate experiments, about experimenting a lot of different avenues and then doubling down on the one that works. It seems that you may have doubled down on just about everything at this point. And I'm so excited to have you in the lab as the co-founder and vice president of SMK Capital, which you've been doing, or capital management, I should say. And it's just very exciting because you have tons of experience. You raising capital, underwriting, rehabilitating, managing, selling, because you also have your license. Literally, we're going from over 120 properties to over $1 billion of combined value. You've managed 40 real estate partnerships plus, and obviously we talked about offline, you're looking to continuously being able to grow that portfolio and also help investors who are going to be undergoing the journey with you. So without further ado, welcome to the lab, Mark. How's it going?
Hey, Robin, I'm doing well. Thanks for having me.
Absolutely. So interesting. This is more of a family business from what I understand, but was it always like this? And the reason I'm going with there first is because the amount of things that you have to put into a business for it to be so successful, and systems and people and resources, I kind of want to get an idea and some background of kind of how that all came together. Was it you who assembled the reins, or was it already kind of pre-existing? You kind of took some things on. How did you put SMK Capital Management together in an effective way for you to actually have results in the marketplace and in a very competitive marketplace?
Sure. Yeah. I'll just say this: a lot of time and a lot of hard work, Ruben. That's really what it takes. But I started kind of my career as a financial analyst, doing a lot of spreadsheets, analysis, budgets and planning, underwriting, auditing. And then I also transitioned into operations management with a different role, a different company. Those two just meshed well together with real estate investing. I started investing on the side, after work, going to Home Depot, fixing up a condo that I bought that I was living in, and just learning by doing. I also had some mentorship through my father. He's been a passive, active part-time investor in real estate since the 70s. So, bounced a lot of ideas and thoughts around him. But basically that was pre-recession when I started, 2005. And at that point, Ruben, if you were in the game back then, there was a lot of appreciation for a few years. So by 2007, I thought I was a genius. I pulled out some money on my condo. I partnered with my brother. I went and bought a fourplex in Hollywood, California, which we overpaid for. We over renovated. We took way too long to do everything and kind of learned hands-on in that one. But fast forward a few years, we started our firm to kind of take advantage of what we saw in the marketplace. So 2009, 10, it was just a ton of great deals out there. And we knew that simply based on the discounts that we were getting, right? The prices had dropped significantly from just a couple of years prior in some markets that we were investing in. And so I started full-time real estate investment, and we opened our firm in 2009 and 2010, right around there. And so we've kind of evolved over the years and began by doing and then expanded to allow us to partner with other people that trust us, like us, know us, and to grow and expand that way.
That's great context. I appreciate that, Mark. So what usually, what would you say is the core pillar of backbone of SMK Capital, because there's a lot involved, and so I'm curious as to always ask is what came first, like as the main pillar? Was it just investing? Was it understanding how to underwrite? What was the first thing, as far as you can remember, that makes the strongest pillar of SMK Capital?
Yeah, I'll tell you, it's people, Ruben. It always has been for us. And there's two sides of that today, right? We've got operating partners that we partner with that handle the day-to-day operations of our investments. And then we've got investors that partner with us and rely on us to be good stewards of their capital. And so people, trust, integrity, do as you say you're going to do. And that has always been, I mean, it was just most important for us, and I think for any other folks listening that are in this space or in this business. We're in the real estate business, but it's people first. I say that over and over because we've worked with a lot of people, and not everybody's great, but when you find those that are, and you can surround yourselves with them and build a long-term relationship, I mean, that's the most valuable piece of the puzzle, in my opinion.
So I think, Mark, you were saying people, right? So at the end of the day, people is what is the backbone and pillar of what you guys are able to do today, right? Now I'm curious, right? And I'm coming from a very curious place. When you're doing the kind of volume you guys are doing today, what predominantly, and again, you said this was, you've made it past the recession, which is a big, you didn't lose your shirt. You've obviously invested very wisely. You've taken care of your people, which is the most important from a trust perspective. What would you say if you met me and I was interested in working with you? What do you get into the granularity of the type of investments that are bringing you the largest returns? Or and the reason where I'm going with this question, just to kind of give some context, is I understand you're in multifamily or mobile home parks, you got ATMs, which I'm very, very curious about that because I'm not too familiar with the concept. When you're bringing someone on board and they're looking to invest with you, do you get into the granularity of what's performing best, what your portfolio is mainly made out of, or it's just like, here's the money, here's what we're going to do with it, and here's where we're going to allocate it, just because you have such a large horizontal kind of I guess pillars set into your management firm?
Yeah, the process is it's basically evolving around what is the investor trying to achieve? What are their goals? What are they looking to do? Maybe where are they in their life, in their career, in that process, young, middle, old, etc. That's really a big part of it for us. We typically talk to every investor one or three times at least before they do anything or decide not to do anything with us, of course. And that process is a lot of times focused around what might be a good fit for them, as far as maybe they're just looking for income or predominantly income or cash flow, or maybe they're not. Maybe they're looking for growth, or maybe it's somewhere in between. And where we think the best position for that capital is today, and try and really make it a win-win for everybody. So that's essentially how the process goes. We focus a lot on diversification, Ruben. We diversify across asset classes, people, and geography. And so we like to have a very well-balanced approach in that sense, and it's got to work for everybody involved.
Got it. And I want to correct myself because I did say management firm, but obviously and what I was going is you're investing, people's money, and obviously you're kind of managing that. So not that you're per se managing firm, but so you talk about income, cash flow, et cetera. So let's say I want to invest. And again, where I'm going with this is, we have a lot of syndicators come in here, et cetera, but it's interesting in your model that you have so much kind of different experience. Some people come in and be like, we just do multifamily. Okay, cool. Fantastic. We're going to go for class B, class C, value add this, that, right? In your case, if I'm interested in, let's say, putting my money to work and my aspirations are, let's say, cash flow, do we then talk about the different opportunities about, hey, consider mobile home, it's crushing it right now, here's why, here are numbers? Or is it like, oh, okay, great, well, we're going to put some towards mobile home, some towards this multifamily apartment deal? Like, what does that look like, just to kind of lift up the hood a little bit of what it would look like to work with you?
Sure. Yeah. I mean, I'll say this, we, meaning myself, my family, have invested in over a dozen different asset classes within real estate over the years. And so we've tried a lot of different things, Ruben. We've also seen the markets evolve from the last 15, 16 years. Of course, there's been tons of changes going on, and you need to be on top of that. It's no less than a full-time job, in my opinion, to really be kind of ahead of the curve or see what might be coming and try and plan and position capital for today's market and tomorrow's market. And so we focus on that every day. With that comes a opportunity to really see where we think opportunities look the strongest going forward. We're really looking for a balanced risk-adjusted return. And so mobile home parks are very attractive today. They're also very competitive. You could see cap rate compression significantly reduced over the last couple of years, to say the least. Apartments are also very attractive today, but again, very competitive. Self-storage as well. Those are essentially our three main today focuses, but also ATMs, as you noted. We've been investing in those for a number of years now. High cash flow, over 20% cash on cash return is what we've been earning thus far and are projected to continue to earn. But there's no growth, right? And so you have to kind of balance it out. There's no perfect investment, but you can create a very nice, strong blended portfolio across asset classes and strategies that we think, really makes it a very attractive overall fund or portfolio for investors.
Great. I'm so glad you said that word blended, because that's exactly where I was going. So you're actually helping me ask this question in a better way. Is it more on a deal per deal basis, or is it more kind of a blended portfolio where you're taking my money and you're kind of investing it across the streams of or areas that you feel might bring me the best return at a macro level?
We do both. It really just depends on what opportunities we think are attractive and available today. And if we see multiple opportunities that we think will really blend together very well, then we might put them together in a fund. And an investor can invest in that fund. They can diversify their capital across many properties, many opportunities, maybe different asset classes as well. But if we don't see a lot of opportunities, because we're very picky on what we invest in, Ruben, I say no a lot. We pass on a ton of deals, especially today. We're at the top of the cycle. Asset pricing has never been higher. Investor demand has never been higher. And so there's a lot of fluff built into these deals these days. You got to be careful. It's what we look out for every day. But when we see, sometimes we'll see an individual deal, maybe just one apartment community in specific city that we like with an operating partner, and we can just deploy capital and invest into that and nothing else. So just to summarize, we look at about 10 to 20 deals a month. We invest in about 5 to 10 a year. Sometimes we'll pool some capital together into a portfolio or a fund, and sometimes they'll just be one individual offering.
That's really neat. And obviously some of us are familiar with, are you working with accredited investors or unaccredited only? Like what is it that who is qualified for these kind of deals that you're working with?
Yeah, it's evolved over the years. Today, it's predominantly almost all accredited investors based on how the opportunities are structured. And so we follow those rules, and almost all of our deals, Ruben, will require investors to be accredited.
That's awesome. Which one is in, because we're going to get into like kind of like operations, because the reason I ask this question is I do believe that it's easier for people to work with you when they understand the model, and yours is very unique. So in your case, do you find that the majority of investors are more interested in the fund or more at it kind of deal per deal? I'm just curious, like what do those numbers look like, and what and why? Do you know why?
Listen, I'll say this: both have pros and cons. There is no perfect structure, and I think based on our research, our experience, we've actually put out a survey last year to our investor group. It's almost half and half, Ruben. So, and I think that way too as an investor. Yeah, that just other thoughts aside, I see the merits on both, and so we do both. That's how we look at it.
What are the I'm curious on that note, and we'll pivot real quick. What is the biggest kind of maybe pro or con on one side that you think, and again, not to beat one over the other, but like what is the biggest, maybe let's talk about funds for a second. What's the biggest pro that you would say to our audience for funds that maybe most people don't even realize is a huge pro?
It's really two things: lower risk and diversification. That's
Got
the
it.
purpose, the main purpose of a fund.
Right. Right.
And assuming you have, let's say, 20 properties in a portfolio or a fund, the downside of that is if one of them does very well, or two or three do very well, your overall return isn't going to skyrocket because it's a smaller percent of the total, right? Versus an individual deal, again, you have a little higher risk because you're kind of putting all your cards in on one opportunity. But you also have the potential to have very outsized returns if it does very well. Yeah. And that's where kind of the balance between a portfolio versus an individual investment works. And we tend to tell folks, spread it out across all of them, right? Yeah. And as individual deals come up, you put a little bit here, a little bit there. And so that way you create an overall portfolio that's, again, well-balanced and diversified.
Got it. So very, very great explanation. I think that helps kind of get context as far as, really understanding what may be best to the person who's looking to invest. So let's talk about something like the elephant in the room. Like we talked about your underwriting, but you're looking at these deals and it's like, sometimes it's just not making sense anymore. Can you talk about that? Because obviously what we've seen or what we're seeing here, I can speak on that. We're in the short-term rental space here in Georgia, and the supply is just gone, right? You got all sorts of demand coming from people are leaving New York, some people coming from California with the virtual living, right? A little bit of a different kind of scenario in our case, but for residential, in our case, it's been the supply is just gone, right? Depleted. Now, sure. Let's talk about at your level, at your scale, whether it's multifamily. You did talk about that. Compressed cap rates. The asking price is just ridiculous, right? What are you seeing? And how are you're saying no a lot, so what happens? Do we stop investing? Is it not making sense on paper anymore? Why won't you pull the trigger on these deals? Let's talk about that.
Yeah. So I'll start by saying, for us, and I think for anybody, a general rule of thumb to think about it, 30,000 feet looking down. If you're analyzing a deal, an opportunity, there's one main question you want to ask yourself at the end of that process. And that is, do you think that this investment opportunity has a high likelihood of hitting or beating the projected returns? And that's how we look at it. If the answer is yes, I'm interested in diving in a lot more. If the answer is, I think that all the stars have to align to get to that projected return, we might pass on it. It's a way of kind of protecting your downside a little bit, and also cherry picking the deals that you think are a little bit more conservatively underwritten, and having that picture in mind. Hey, I think we can probably beat these returns that we're looking at. So we look out. Yeah, there's a couple metrics too, which I'll share as far as financials. If you're going to analyze and underwrite opportunities, you want to look at projected occupancy. What's the assumption there? Really, you want to look at physical occupancy and economic occupancy. And so if people are staying in an apartment community, but they're not paying rent, might have high physical occupancy, but lower economic occupancy. You want to look at those projections. What have they been historically for that submarket and for that property? Where do you think they're going and why? And there's a lot of data in apartments out there. You can pay for the data and you can get it pretty easily and analyze it that way. You want to also look at rental growth projections. Same concept, right? What's the average rent today? What has it been? Where do we think it's going? Can we manipulate it manually or organically, right? Natural market appreciation versus coming in and adding value and doing a lot of renovations and making the apartments much nicer, increasing curb appeal, et cetera, and putting a lot of effort, time, and money to improve rent growth and net operating income. The other is cap rates. What's the going in cap rate? What's the projected exit cap rate? Where do we think the trends are? These are some of the assumptions, Ruben, in a investment model that can easily affect the projected rate of return for that investment. Yeah. Of course, the price we talked about, are we overpaying? Are we at market? Are we slightly below? You want to be able to figure that out and really get comfortable with the price. And then something we look at, if we're looking for income and growth, which is how most of our investments we target today, we like to have both. We'll look at the total return. Let's say we're projecting on an investment that 15% is the average annual return net to our investors. I want to know how much of that do we think is coming from cash flow, which is just the rental income and the distributions that investors are going to earn throughout the life of the investment, and how much is coming from appreciation when we go to sell it, how much of that's profit on the back end. And this alone can help you dissect and kind of find investments that might be a little riskier than others. For example, if you take an investment that has a 15% average annual return, but 80% of that return is coming from the profits on the sale and 20% is coming from the rental cash flow and distributions while you hold, that to me is pretty heavily skewed towards more of a speculative value add play versus maybe 50-50. So
that is really interesting. Yeah. I've never heard of that breakdown. That's fascinating. So there's even a level when you talk about, you can even break it down a layer deeper of like the actual return, where it's coming from, like at like even a deeper level than just hey, this is the projected return. But now you're even going from the price, from the value add to the interesting.
Yeah, it's really important today for us, again, where we are in the market. We want to underwrite as conservatively as possible, meaning I want to take these assumptions I just mentioned to you and pad them, right? And say, hey, if projected occupancy dips by 10, 20%, where are the returns going to be? If cap rates go up by 50, 100, 150 basis points, what are the projected returns going to do? And that's how we run sensitivity around these opportunities and how we essentially help reduce risk and cherry pick what we think are the best deals.
Wow, that's really interesting. So in that case, then, if the projected returns, if it appears that you could kind of really hit or even outperform the projected returns and something is overpriced, do you still pull the trigger on it then?
It's a good question, Ruben. And I'm sure people see that situation all day long. So especially in today's market.
Yeah.
Maybe the maybe comes because it depends on the business plan and it depends on our partners, our operating partners. And I'll kind of give you some examples too and thoughts there as why we may move forward if we think the price is not as competitive as maybe 5 years ago, which is often the case these days with deals. There's a lot of eyes on them. Cap rates are going down. And so, that's just the nature of the market. If you don't get used to that and comfortable seeing it, then you're probably not going to invest in a lot of deals for the next few years. But with that, how do you protect yourself from overpaying? Well, we look at the business plan. Number one, what are we going to do to this asset to grow the net operating income? Specifically, what is the step-by-step process? How long is it going to take? How much capital are we going to inject? And why do we believe that this is going to be successful? Have we done it 50 times before and we're just rinsing and repeating? That really helps reduce risk, right? Hey, we've done this in this market. Here's 10 examples. Here's where it's worked each time, and we can go and rinse and repeat. That really helps reduce operational execution risk. In addition, if you have a value add plan where there is some mismanagement, there are some outdated or more classic style design upgrades that are needing renovations and needing to become current with the market, you have the opportunity to grow rental rates. That's the kind of business plan that we're looking at. So almost everything we look at today is value add focused, where we are already knowing from day one that we're going to grow the value manually by doing a lot of things to grow rent and to reduce expenses and increase the bottom line. And so it's a very hands-on approach, but also it helps reduce risk of overpaying. And it oftentimes can lead to, great yields and great returns if you think about it in that context. We're not really buying anything, Ruben, and just sitting on it and let the market control future valuation.
Yeah.
That isn't our strategy.
I'm glad it's not. Mark, one thing that's really like so interesting with this conversation is that you're going a layer deeper than I'm always, when I ask a question, I ask it and then you're going a little layer deeper. The part where you said is that I'm familiar with, or that kind of jumps out at me, is the have we done this before? So, you can say this at scale. Yeah, we do value add, but you're even saying, okay, a layer deeper. What are you, have we done this type of value add, right? So now let me ask you, just give some context for our listeners. What's one thing, right? Because you've been doing this now with the company and the business for over 15 years. What's a kind of maybe value add a layer deeper that like you maybe haven't done? Is it using different vendors, adding the risk? Is it because where I'm getting at with this question, Mark, is you're saying, hey, have we done this before in one of our portfolios? Yeah, we did this in Texas. Yeah, we did this. But what is it? Is it the exact same strategy with the exact same material with the exact same vendor? Is that how granular you're getting?
Yeah, sometimes it is, Ruben. For example, we have an operating partner that they've got about $2 billion in assets under management. They are a multifamily value add investment firm. We've invested with them several times successfully thus far. And what they do is they literally do the same exact renovation to every single apartment community, time and time again. The same faucets, the same flooring, the same paint. You get where I'm going here.
Absolutely.
It's rinse and repeat. And so that is, to me, a strategy that's been proven. They brand their properties. They all look the same, which we actually like, and it works very well. And they've been able to achieve, outsized performance pretty consistently on a lot of their investments. We've got another firm that we work with. Same concept, Urban. They focus on low-income housing tax credit investments or tax abatement properties. And they do the same process over and over and over at all of their properties. They, I think, also have about 1.5 billion in assets under management. And they've had about 30 plus investments go full circle that have achieved over 25% average IRR net to investors. So these are the types of operating partners, that we look for in today's market to build relationships with, to invest with, and to partner with. And that's where we think we help reduce some risk, we're at the top of the market cycle, and we probably will be here for a little while longer, to say the least. People first, like I mentioned, right? So if you find true experts that do one thing very well and partner with them, that's essentially what we focus on doing every day. And then I think you asked what aren't we doing, and I'll give you an example of that too.
Because you said you say no a lot. So what are you saying no to?
Yeah. So if the value add plan is too heavy, we'll probably pass. And I'll give you kind of an example of that. There was an operating partner in the storage space that we've worked with, and they were going to redevelop an old J.C. Penney's into a self-storage facility. And so sounds pretty interesting, right? I mean, what else are you going to do with that giant space today? And it's in an urban infill area that seemed to have a deficient amount of storage. So we look at that, I say, wow, this is interesting, but it's all growth, Ruben. There's not any income throughout that process. And it's a higher risk investment because of that. And so we typically we'll pass on those types of deals, even though they're attractive, even though they have potentially great returns. The risk is too high for us typically on that.
Interesting. It's so funny you went there, because that was going to be my next question. When I was asking, and maybe as a listener, we're so primed to look at something in the lens of what we already know. So my next question was going to be, okay, this sounds great, value add. We were just talking about offline before we got on the air that we know a gentleman in my network that's doing value add specifically with closets, right? Like getting that granular, but that's for multifamily. So now bringing it full circle, we talked about ATMs, self-storage, which you just mentioned, multifamily, mobile homes. Does that assessment or the lens of how you say, hey, how are we gonna just look at the increasing the NOI and income growth and value add? Can you take this value add approach and framework and just plant it for all of these other ones as well, and it works, or it's a complete different ball game here? Fill us in.
Yeah, that's a good question, Ruben. So I'll start with apartments. So I believe that apartments often have one of the most reliable strategies to increase value, which is renovations, which is curb appeal, which is increasing rents, right? You can do a lot to them to grow value. Next would be mobile home parks. Typically, we try and focus on mobile home parks where the residents own their homes and they pay lot rent to us. It's getting harder and harder to find those parks that are priced properly, in my opinion. So there might be some, let's call it 10, 15% of the residents don't own their homes and they're leasing. So there could be an opportunity there to do lease with an option to buy, or to try and sell that home to just get the lot rent and have the resident, essentially own their home. You also can bring in, if there's vacant lots, this is a big value add play in mobile home parks, is to bring in new homes or used homes to the park and to sell them. And it's not easy to do, but this is where we focus on operating partners in that space that have done it many times. They're very good at it, and that's all they do, and we'll partner with them. And so that's one area, I think, in mobile home parks that we love to see is infill of vacant lots for value add. Storage is a little more difficult. And I'll say this, if you're going to go rent a storage unit, Ruben, do you care how old it is or how shiny it is? What do you care about?
That my stuff are safe. We'll just say stuff. That my stuff are safe. That's all I want.
Yep. Safety, price, and location. That's what people want. And so
that's right. Yeah, that's right.
So for storage, it's a little harder to create value. There's definitely ways to do it. You might find that the demand for a 10 by 10 in your submarket is so high that you've got too many 5 by 10s. You might want to knock a wall down and connect them and then repurpose them and make more 10 by 10s. So there's ways to do that to grow value. You can also add units. That's what most self-storage value add looks like, is, organic rent growth. Leases are on month to month, so you can typically raise them within 30 days notice, which is a very attractive feature as an investment strategy. But you also have the ability, if you have space on the land, to build more units.
Can you? Can I add to that? Can you also, is it technology involved? Maybe keypad locks, like, that are less bodies on the ground. Like, I'm just trying to think here, just because we come from the short-term rental space, and it's like a lot of it is like everything is accessible digitally. Is that a thing? Digital tech coming into play?
Yeah, absolutely, Ruben. So for storage, there's a lot of facilities out there today that have no staff. They're all digitalized, right? So there's a keypad, there's a fob, you enter the gate, you go to your door, you do your business, and you leave. There's also what's also quite interesting to me that I'm seeing lately is there's a lot of software. There's a lot of tech where you can compete with the REITs of the storage space that will price a 10 by 10 unit on a Friday afternoon much different than a 10 by 10 unit on a Tuesday afternoon. That's how competitive it's become. So we look for operating partners that are very much in that space, that are specialists in that, and that they can have very dynamic pricing based on competitors' pricing down the street and based on demand, per day, literally is how that tech has evolved in the storage space. So yeah, I'm glad you asked. It's revolutionary.
I love that.
Yeah.
I love that, because we have something similar in the short-term rental space, and it's like, you got like pricing labs, you got all that. As the supply and demand rises and changes within your area, the pricing goes up. But it's interesting, because I never thought for storage, are we then saying that the pricing, I don't know if this is where you were going, and maybe I'm jaded with my vision and my lens. That's what I'm asking. Were you then saying that, let me preface by saying this, are most self-storages month by month?
Yes.
contracts, or they are? Okay. So you're saying that if I'm joining maybe in January versus May, or I guess what, we're in July now, 2021, the price may be different, and you're using maybe a software to kind of analyze the supply and demand, or I guess the demand of the storage facilities.
Exactly, Ruben, right? So listen, if there's, let's say within 5 miles or 3 miles of your facility, there's three other facilities that they're offering the same thing, right? Again, storage, you don't care quite as much how shiny and bright and new it is. It's more what's the price and location and security. So if you're able to know, hey, the three guys down the street, the 10 by 10 is $109 at competitor A, $104 at competitor B, and $92 at competitor C. If you're able to know that real time and adjust your pricing accordingly, you will have a lot better competitive advantage, in my opinion. And that's where we think there's a need for technology, to say the least, in storage.
Yeah. You would just need, I'm coming up here and my entrepreneur mind's running. You would just have to have a kind of a joint kind of network that would allow you to know the inventory, right? Like if you're talking like Airbnb, who's getting booked and stuff, who's not. So you'd have to have a standardized kind of platform that would know. Does that exist?
Yes, actually, one of our operating partners, I think they're a top 15 largest self-storage operator in the country. They built that in-house. It's proprietary software, and there's an algorithm that's constantly looking on the internet and pulling in data on local facilities. And I think they've got over 70 storage facilities nationwide. And so, and they have dynamic pricing that adjusts automatically on their website based on market conditions. And so,
and based on availability too.
Yeah, it depends on availability. Of course, the availability of your storage facility, right? And you might know how long those 10 by 10s have been sitting vacant, right? So, hey, it's been longer than 30 days or 21 days. We want to have that unit come to the top of the list and have it available. Maybe you even offer a concession automatically, right? First month free, or rent a truck for free while you rent this unit by the end of the month, right? Those kinds of incentives are what keep you ahead of the competition.
Mark, you have to, I am apologizing on behalf of my listeners. You guys know I'm a tech nerd. I had to go there. But let's just bring it back, because Mark was going somewhere here. We were talking about value add, and Mark was helping us understand how predominantly in apartments, we see it as very effective, right? It's easier. Like there's so many opportunities, right? Then there's mobile home parks, which is fascinating because we talked about during different models, whether it's paying by the lot or maybe the lease, and which is interesting. Mark can speak on that because he's the expert. Then self-storage, which now we're talking about the technology. We're talking about adding more units. So this leaves us with ATMs, which maybe we save the best. And when I say the best, I mean it from interest, because I haven't really heard of this. I've heard maybe another individual mention it, but ATMs, what's the gig there? That couldn't be that. You talked about income and growth. I'm taking notes here. I'm listening to you, brother. Income and growth. So ATMs, that's just a growth income play, right? Like, do you just get more? And what does that look like? Please allow us.
Sure. A close colleague of mine, Ruben, about 10, 11 years ago, very sharp, astute investor. I asked him, hey, what's the highest cash flow investment you've ever made? And at that point, he had been in about 70 different investments. Without blinking an eye, he said ATMs. And I was so naive at the time, I didn't know what he meant. I thought it was an acronym for something I wasn't aware of, right? I didn't realize he meant the cash machines. It always stuck with me, right? That was 10, 11 years ago. And then by 2018, 2019, he came to me and said, Mark, we got to talk. I've got a really exciting opportunity to share with you. And it was with an ATM space as well, Ruben. So what it is what we do is we partner with the 5th largest ATM operator in the country. They have a portfolio of over 10,000 machines across multiple states. And we all they do is ATMs. They've been doing it, a lot of the staff, since the 90s. They know all the trends for what's going on in that space. And we partner with them. And so the way it kind of works, Ruben, it's a cash flow play, like you mentioned. There's a large demographic of people in the US that still rely on ATMs for access to money. They it might be by choice, it might be by demographic, it might be by their inability or lack of want or need for credit cards or more digital currency, right? And so they use cash regularly, and this ATM operator tends to focus on that demographic. And so when somebody withdraws cash, there is typically a fee, anywhere from $2 to $3 or so. That fee is split amongst our operating partners. It's split amongst the retailer where the ATM sits, and it's split amongst us, the investors. And so we're all essentially incentivized to find locations that have high foot traffic and no transactions.
Absolutely.
Yeah.
That was going to be my first thing. So you guys must be big on like, you'll have to excuse me, concert venues, maybe, or I'm just trying to think, like, you tell us, why am I guessing? I have Mark right here. What is like one that you're like, wow, you would have no idea about that, where you typically would place the most ATMs in yeah, what is that location that we might not even realize is a big one?
There's a few, and they've evolved over the years, Ruben, by tracking trends. And so they no longer have ATMs in malls. They no longer have ATMs in more retail stores. They no longer have ATMs in hotels and casinos and that kind of thing. Their focus has been more on essential businesses. So convenience stores, gas stations, pharmacies. They also look at rest stops. Say again?
Nail salons.
Nail salons. There you go. Yeah.
I think the reason I say that, I think they tip in cash and they do a lot of
They
stuff.
typically do tip in cash. Yeah, it's good. But also farmers markets are one of the biggest sources because a lot of them only take cash. And so there's a farmers market in Pennsylvania. I think it's one of their highest transactional machines, and it gets thousands of withdrawals a month. So that's the biggest one.
That's crazy. See, this is why I like having guys like you step into the lab, all these experiments, all consolidated, all together. Now, I got to ask you, if you only had one asset, or is that, I want to make sure I'm using the right terminology. Would you consider that like an asset, like,
asset class?
Asset class, right? Cool. Which one? Again, I know they all have pros and cons. I got opinion. I told you I'd be hard on you. Mark, what is the one that if you can only pick one that you would just say, Ruben, I gotta pick this one? Which asset class? You have no choice. I'm putting
this. I can't tell you. I don't.
Oh, come on, Mark.
All right, I'll say it like
it's like your life depends on it.
Yeah.
You got 3 seconds to make a decision. You got to pick
Sure.
one. Which one comes to mind first?
Manufactured housing, mobile home parks, and apartments are both.
Kidding, really?
I don't know if I could say that one's better than the other. They're the top two. And
wait, one more time. You said
like
manufacturing. You said mobile.
Yeah,
home
mobile
parks?
home parks. Yep.
Wow. Now you got to tell us why.
Well, again, it goes back to our thesis of where we think that we are in the market cycle, where we think things are going, and where we think we have the strongest tailwinds and best downside protection. And I'll say most manufactured housing or mobile home parks have, in my opinion, the highest likelihood of rent growth. They're still the most affordable housing solution. I don't think that's going anywhere. They have a limited supply. Most cities, municipalities don't want any more of them in their backyard, and zoning restrictions often prevent new manufactured housing communities or mobile home parks from being built in desirable areas. And so a lot of the best locations, they were built, decades ago. And so there's a barrier or a moat around them from new supply. And there is a growing, consistent, strong demand from residents and homeowners for them. And so a lot of them have waiting lists, Ruben, today for people who want to move in. And so I think if I had to place a bet on which asset class has the highest likelihood of continuing to perform and to continuing to grow, it would be mobile home parks.
Okay, cool. And I want to make sure I understand, when you say new manufacturing housing facilities, like, can you elaborate on that?
Yeah, mobile homes are manufactured in warehouses, industrial spaces, and then shipped and delivered and set to the lot. And so,
Okay, so they're one and the same. They're not
they're
different,
one
because
and
I
the
know you
same.
said, okay, got it. I didn't know they were called that. I didn't realize.
Sure.
I didn't know if you were, because I had a gentleman kind of talk about this is very different. Like, it was like more of I guess there would be facilities like, if you think about fulfillment centers for like, like Amazon and stuff like that. Those are
Sure.
like facilities, like warehouses. I think that's the word I'm thinking of. So I didn't know if you had said that. I just want to be clear for myself and our listeners, that you were talking about mobile home parks is one and the same.
Yep, they're synonymous. Exactly.
I love this. So bring it full circle. It's 2021 August. Where is the attention? We didn't even get, first of all, thank you so much for the time you spent with us, kind of going through your experiments. But before, I let you go, I need to ask you this okay, we know that there's a lot, you said it's competitive, right? Multifamily is competitive. Talk about mobile homes. Where is your attention right now going with all the asset class verticals that you got going on in your business? Which one are you all kind of maybe doubling down in a little bit more? Is it what you just talked about, mobile homes? I know, or is it kind of, maybe it's even a process, maybe it's a side, maybe it's the underwriting has gotten so out of control that we need to allocate more resources towards that to be able to say no? Like, is there one thing that you're spending the most amount of time and energy right now that you can share with our audience?
Yeah, I'll say, for the last several years, we've been focusing on mobile home parks and apartments. And today I'm seeing shorter term multifamily or apartment opportunities that I think are going to do very, very well, Ruben. The tailwinds that we have in the marketplace today, the lack of housing across the country. A recent report noted there's 5.5 million units deficient from supply demand standpoint. And that disequilibrium is across single family homes and multifamily apartments. It's actually around 2 million single family homes we're short as far as the demands in the marketplace today, and about 2.5 on apartments. And so if you look at how long it takes to build that much, it's at least 10 years. And that's assuming that if you look at historical amounts of new supply coming on the market, if we pick that pace up, then it's at least 10 years before we hit that gap that we're seeing. And I just don't see that's happening anytime soon. Rents are on the rise. Home values are on the rise. The demand for housing and affordable housing in growth markets is stronger than we've ever seen. And I don't think that's going anywhere. The affordability gap is still a huge issue. I don't think that's going anywhere. And that tends to have a lot of folks seeking out apartments, which are, of course, a little more affordable than single family homes. And then the work from home trend has accelerated significantly, right, Ruben? You've seen it. I've seen it. Yeah. And a lot of the southern states that we focus on have been benefiting from that, yeah. Places like Phoenix, like Las Vegas, like Dallas, Austin, et cetera. And so we're also seeing that the trend between interest rates and cap rates, some of the research we've done, we see that, listen, let's say interest rates go up. Everyone's worried about that. Oh, if that happens, then there's going to be a big shock to the market. I don't know if that's going to happen. I think that we might see cap rates stay where they are, or even potentially continue to compress. And that's what they've been doing. And so we think that the near term, call it 2 to 3 years, there is an opportunity to invest in value add multifamily with that shorter time frame in mind. There's just this huge supply demand disequilibrium right now. There's a lot of tailwinds. There's so many investors paying premiums for these assets. And we think that trend's going to continue. And so we want to get as many of them as we can now and be sellers in a few years. And so that's something that we're heavily focused on today.
Got it. Could you elaborate more? So I want to make sure we're clear on this. When you say short-term multifamily, what does that mean?
Sure. So we've done two in the last couple months. Essentially, what they are is we're acquiring assets, typically between 200 and 300 units that have high occupancy at the start, Ruben, right? Usually around 90 to 95% occupied when we acquire them. So they're already producing positive cash flow and distributions from day one. But there's an opportunity at that asset to increase the net operating income by doing renovations like we talked about, by coming in and enhancing curb appeal and just making it a lot nicer, and also increasing the rents, right? If the market rent is, the current rent, at the property is below market, we come in and we add value to the asset, then we can charge more of a market rental rate. And if you do that enough times, right, let's say you renovate 30% of the units, 40% of the units, there are many buyers or many other investment groups waiting to buy that from you and finish the renovation on the 50 or 60% that are left. And they'll pay a premium for it because you've proved to them, hey, if you do X, Y, and Z to these apartments, you can get this much rent instead of where it is today. We've already proven that to you. Go ahead and finish it, right? And so,
oh wow, so you're starting off your business plan, and then you're saying, you know what, never mind, we'll let somebody else buy us out.
If that's what we're seeing today, there's a very strong opportunity to renovate 20 to 30% of the units at an apartment community, raise the rents, prove the model. And there's a lot of other groups out there that will pay a premium for that. And
you're handing off the scope of work.
Correct.
Jeez. That's interesting. See, that's why I had to ask the question, because you're so familiar with it. We're like, I hope that helped understand the opportunity there. The second question I'll ask, and probably one of the last ones, I just want to talk, because you talked about 2 years for new construction. Why not go? And this is a kind of a devil's advocate question. Why not go into developing multifamily apartments?
Yeah, I mean, I just find development in general is a higher risk strategy.
Okay, fair enough. Yeah, that's right.
Yeah. No income. It could take 3-4 years before you see anything. And so there's merit for it. I get it. But I'm also seeing these days, Ruben, a lot of development deals have some of the same returns as our value add deals. And so I no longer see that spread between return of value add versus return of development that is attractive enough for me to take that risk.
Yeah. Plus there's a lot of front end capital, and rather you're not getting any income. You're pouring
Correct.
into it.
Right.
Which again, I'm sure, I haven't raised capital myself or on a fund, but I'm sure that could be a very different play for the investors involved when you're pouring in a lot of money and no money is being generated.
Right. Yeah. You're waiting all for the back end. So going back to that ratio we look at of how much of my returns coming from cash flow, how much is coming from appreciation, it's 100% on the back end and appreciation for development deals.
Absolutely. And today was more than 100% of return that we got on the listeners' time, because you literally over delivered and give us so much value. Now, look, I like to just give as much shout outs as possible because obviously you've done a wonderful job. You can check out SMK CAAP, SMKCap.com to check out more of what Mark and his team at SMK Capital Management is bringing to the table. Actually, let me ask you, because I know I've actually said the names twice. I want to make sure I'm accurate. Do you have also property management in-house, or is that a third party?
Yeah, we so what we do is we partner with other investment firms, Ruben, that specialize in one thing, and a lot of those firms have in-house property management.
Gotcha. That's one thing I didn't know, because I want to make sure I'm always saying the name, and I want to make sure people get. So SMK Capital Management is just you managing other people's capital, investing with them, and bringing them the returns, and then obviously you're leveraging the resources internally with all the asset and verticals that you've talked about on this show, which honestly I'm going to listen again for my own myself. But I do want to give you the opportunity to give our listeners a special plug. I know you have a lot of resources that you give our listeners. Where can we find out more about that, and where we can tap into that resource prior to or after listening to the episode?
Sure. Yeah. Thanks, Ruben. I would just say this, if you're listening and you're interested in passive income investments, you can go to our website, smkcap.com. And then we have a link there. It's smkcap.com/5 steps, the number 5 and then steps. It's just a free download. It's what I put together, I think is a very great resource to help folks navigate all the opportunities out there today. It helps you see through a lot of the fluff to really best position your capital in private passive real estate opportunities today. So I think that's a great resource. I'd recommend a lot of folks to get their hands on.
Absolutely. If you're driving, keep your hands on the wheel. We'll have that in the show notes. And without further ado, an experimenter stepped in, wore his coat into the lab, gave us the ingredients and gave us the frameworks and blueprints that he uses in-house to elevate the people that he is investing with. As you said, opening up the show, that you're as good as the people you're surrounded with. Today, we were super honored to have you into the lab. We were as good as the resources that you shared with us. So thank you, Mark, for stepping into the lab. And just like that, we are out.